Hello, everybody, and welcome to the fall 2021 financial accounting. I'm here. Let's spend the first hour and a half going over questions. One thing that's important to me is if you have a question, please feel free to butt in, or I'll try to look at the chat if I see something's coming up on chat. But if you're having questions as to what I'm saying, chances are other people are too. So please look, ask a question, because if you're curious, I'm sure others are too. So guys, this is financial accounting. And a lot of business programs, you're required to take the financial accounting and the managerial accounting. So for this financial accounting, what we're going to be learning today revolves, what is financial accounting all about? Well, we are going to talk about some overall basics in financial accounting. So many people think of accounting and they just get scared because somehow they think it's equated to math, and math is a little scary for everyone. Accounting does deal with figures, with numbers, but it's a lot more than just dealing with numbers. Accounting is what we call a measurement process and a communication process. Guys, know these are the two primary functions in accounting. There are people out there. There are investors. There are creditors. There are customers and suppliers and employees and managers and competitors, regulators, the community, tax authorities. These people all need to make decisions about companies. And the way in which they make decisions about companies is by looking at financial statements. So there may be people who decide, do they want to invest in a certain company? Well, they use financial statements to help make that decision. Or there may be banks that decide, do I want to, or trying to decide, do I want to lend this business money? What do they use? They use financial statements. There are oftentimes many communities that make decisions on companies, and oftentimes these are tied with financial statements. So know that all people will make decisions about various companies. Now, these companies have various activities that they continually not provide, but do have various activities. And these activities they do get measured by accountants. And these accountants put these various activities in the form of financial statements. And those financial statements serve as a method to communicate information to investors. So this is really ultimately the framework of what the purpose of financial accounting is to measure activities and then communicate those activities in the form of financial statements. Now, there are two kinds of categories in accounting. We're dealing with financial accounting in this class, and this is information that's provided for external users, for the public at large. Managerial accounting is a different type of accounting, which provides information to the internal users of a company. So that information is much, much more detailed, where the information that we're providing is more broad for external users. So remember, we are going to focus on how is the business activity being measured? And then how is that activity going to be communicated? So guys, we're going to start with some questions here. Which definition below best describes financial accounting? Is it the process of measuring income taxes owed to the government? A system of maintaining communication with a company's customers and suppliers? Is it procedures designed to enhance the company's image to potential investors? Or is it measuring activity, business activities, and communicating them to external parties? What do you guys think? You can put it in chat. A, B, C, D. Lots of D's. D, 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 D. Oh my gosh, you guys are so smart. I think you are right. Measuring business activities and then communicating them to the external parties. Here's another one. Financial accounting does not deal with which of the following: measuring a company's economic activity, providing information to internal users, preparing financial reports, or communicating financial results to investors. I think you guys know it. It does not provide information to internal users. Okay, so guys, we're going to talk about some various activities that companies perform. And in this example, we're going to take this Eagle Golf Academy to really explain various types of activities. So here we have this new company called Eagle Golf Academy. Eagle needs $35,000 to get the business going. The company needs investors. So they reached out to various people to sell common stock at $25 a share. They decided they were going to raise $25,000 of their money by getting shareholders that would be investors in their company. And then they were going to borrow $10,000 from the bank. So they got some various individuals, friends, family, to invest in various shares. Grandma and Grandpa Q, Eagle Eye Ed, Eagle Eye's parents, Bogey the friend, and Sucker the coach. They raised $25,000 in stock. Or basically what I should say is they had stock available and various people invested in the company, $25,000. So then they borrowed $10,000 from the bank. So this is an activity, guys, that they performed. So how will we measure this activity? Well, what we know happened is they received $35,000 in cash. This $35,000 in cash came in the form of a note from the bank, which we are going to call a liability. And we'll talk about that in a little bit, why that is a liability. But basically, it's money that they owe to another person. It's a sacrifice that required, or it's a benefit to the company right now, cash, that requires in the future a sacrifice. They need to pay that money back. But then they also have shareholders, and they have $25,000 they received in stockholders' equity. So what we're doing is we're looking at an activity and we're trying to measure it. We're measuring how to communicate this activity of raising money. So we had cash of 35,000. It came 10,000 from liabilities from the bank and 25,000 from stockholders' equity. Now we need some equipment. They need to purchase $24,000 of equipment, and they're going to use cash in order to raise that equipment. And so, or to purchase that equipment. So you see in this journal entry, we show equipment was purchased of 24,000, and the manner in which we bought that equipment was in the form of cash. So now you see at the end of those two activities, we have resources in the company right now of $11,000 of cash and $24,000 in equipment. The claims to those resources are creditors. We owe the bank $10,000, and the shareholders have a $25,000 claim to those resources. Do you see here that the resources equal 35,000 and the claims to those resources also equal 25,000? Probably one of the very most important concepts you're going to learn today is what we call the accounting equation. The accounting equation shows that our assets or resources we were talking about in the previous slide will always equal liabilities, those monies we owe, plus stockholders' equity, those individuals who have ownership in the company. So the assets at the end of every journal entry will always equal liabilities, the creditor's claims, plus stockholders' equity, the owner's claims. So after just those first two entries, we see that our resources, cash and equipment, which we also will call assets, equal liabilities, which are the creditor's claims, plus the stockholders' equity, stockholders, which are the owner's claims. Now we can take that equation and, of course, move one of the change it up. Instead of assets equal liabilities plus stockholders' equity, we can also say assets minus our liabilities equal stockholders' equity. So assets are the resources of a company. Liabilities are the creditor's claims to those resources. And stockholders' equity are the owner's claims to those resources. Now we're going to learn something else today. We're going to learn about revenues, expenses, and dividends. All of the profits of the company are claimed solely by the stockholders. What does that mean? The stockholders own the company. So when the company earns profits, those profits really are for the benefit, ultimately, of the shareholders. They invested in the company and they want a return on their investment. Now, profits are the revenues that are brought in to a company minus the expenses. So revenues are the monies that are brought in from either selling services or providing goods, minus the expenses. The expenses are the cost to provide those revenues. The revenues minus the expenses equal profit. And another word for profit is net income. Revenues, again, are the sales of products or services to customers, and expenses are the cost of selling products or services. There's something else we will call dividends. Dividends are not an expense. Dividends are distributing the profits to the shareholders. It's not a cost of making revenues. It's basically handing out the profits to the shareholders. So let's talk about the activities that happened in the first month of business for Eagle Eye. Eagle Eye had $3,500 in revenues from lessons, and it had expenses of $1,000 in salaries, $500 in supplies, and $700 in miscellaneous items. So an income statement, this is a form of communication. The income statement provides external users with the revenues, the expenses, and the net revenue or the profits of a company over a period of time. As you see here, the revenues show $3,500. Then we have 3 expenses: salaries expense, supplies expense, and a miscellaneous expense, with our total expenses being $2,250. The difference between our revenues and our expenses is what we call net income. So, as you see, businesses perform activities. And these various activities can be related to the resources of a company, which we will call assets. Activities related to the amounts owed to a company are called liabilities. And then activities related to the stockholders' investment of a company are called stockholders' equity. Then we have some other items. We've got distributions to stockholders that we now know are called dividends. So the activities related to the distribution to stockholders, we're going to put them in a category called dividends. Then we know that sales of products or services are activities a company provides, but we're going to put it in the category of revenues. Then activities related to providing the costs involved with providing sales are going to be labeled expenses. So what we're learning here is there are various activities, and we are going to measure these activities, and we are going to put them in various categories so we can help communicate what happened in the company throughout a period of time, and we express it within various categories. Now you see here on this slide that items related to assets, liabilities, and stockholders' equity are part of the accounting equation. Assets or resources are equal to the liabilities plus the stockholders' equity. Then we know revenues and expenses will make up net income. So the revenues minus the cost to provide those revenues equal our net income or our profit in a company. Know, guys, that the measurement role of accounting is to create a record of the activities of a company. And in order to do this, a company must maintain an accurate record of its assets, of its liabilities, of its stockholders' equity, of the revenues, of the expenses, and also of its dividends. So guys, what do you think here? The resources of a company are referred to as, you want to write your answer in the chat box? The resources are called, I'm going to let a couple more people put their answers in. Got like 5 people. There are 18 people in this class. So what are we missing? Great. Okay. So guys, aren't they resources? Excuse me. The resources of a company are resources. Aren't they called assets? Assets is synonymous with resources. The amount recorded when the company sells products or provides services to customers are referred to as A, liabilities, B, revenues, C, assets, or D, expenses. What do you guys think? Revenues? Does that make sense? Revenues are recorded at the time the company provides products or services to its customers. So guys, I want you to take a minute and I want you to, on your own, match up the left-hand side with the right-hand side. Now, I'm not going to ask you to share your answers. I want you to attempt this because this is a good exercise to help you understand if you're picking up on what we've gone over just right now. So I'm going to give you about 3 minutes to kind of match them up, and then we'll go over the answers, okay? I'll be right back. Okay, guys. So liabilities. Actually, I think it goes the other way. I think we start with land. What is land? Owned by a company, it's a resource or an asset. Amounts owed to the bank, it's a liability. Common stock issued to investors is stockholders' equity. Payments made to stockholders will be dividends. Cleaning services provided to customers are revenues, and workers' salaries for the current period are expenses. Anyone have any questions on any of these before we move on? Everyone good?
Yep, thank you.
Okay. We're going to look at our first exercise. Now, guys, I incorporate these exercises to really help comprehend or understand the material. Actually, this could possibly be one of our homework problems. The numbers may be different, but we'll get to all the homework too. So guys, here is Fighting Okra Cooking Services. On December 31st, this company reports the following revenues and expenses. So it's providing us with service revenue of $75,000. And then it has postage expense of $1,500, legal fees expense of $2,400, rent expense of $10,600, salaries expense of $24,000, and a supplies expense of $14,500. Now, the only thing we're going to do with this problem right now is to prepare an income statement. I'm going to give you a hint. An income statement consists of revenues minus expenses. And I'm going to give you a hint about revenues usually have the word revenue after them. And expenses usually, almost always, have the word expense after them. Now, there is a revenue that, or a word that has revenue after it, but it is actually a liability. And we'll cover that in another chapter called deferred revenue. It's basically revenue they haven't earned yet. So it's called a deferred revenue, and that is truly a liability, not a revenue. But apart from that one example, usually if it's revenue, it will have the word revenue in it. And usually if it's an expense, it's going to have the word expense in the name. So to create the income statement, we take our revenue, our service revenue of $75,000, and we list all of our expenses. Our total expenses are $53,000, and our net income is going to be $22,000. This is what we call the income statement, guys. Our revenues minus our expenses. Okay. We won't get to the other part of this problem till down the road. Now we're going to kind of circumvent a minute and talk about various business structures. There are three predominant structures that individuals use for companies. One is called a sole proprietorship. It's just the easiest formation, is a business owned by one person. One is called a partnership, where there's a business owned by two or more people. And the other one is called a corporation. Now, the beauty of a corporation is it's a business that's legally separate from its owners. The beauty of that is the owners, or the stockholders of the company, have limited liability. So they're only liable for what they have within the company. So those three are the various business structures. Now we're going to jump to talking about various activities within a company. There are three types of activities within a company. One is called financing activities. That has to do with transactions between investors and creditors, borrowing money, paying back money, receiving stock or cash from distributing shares of stock, paying in dividends. Investing activities have to do with transactions involving the purchase and sale of resources that provide a benefit for several years. Usually, this is involving long-term assets, purchase of long-term assets, or the sale of long-term assets. Then everything else a company does is usually categorized into what we call operating activities. The operating activities are the transactions relate to the primary operations of the company. Why the company's in business to begin with. So if they're a cooking company, it's going to be involved with cooking and the costs of providing that food. If it's a golf company, it's going to be golf training, and then the costs in providing that golf training. So guys, be familiar. This is chapter 1 is a huge overview of the whole book. And so you're learning a lot of general items. So just make sure you kind of write down the various categories we're talking about so you don't confuse them. Financing activities are related to issuing stock or borrowing money. Investing activities have to do with purchasing or selling long-term assets. And operating activities is everything else. The revenues from the services or products and the costs in providing those services or products. Now, we're going to take this exercise, and I want you to look at each one of these and determine, is the transaction an activity that's related to financing, to investing, or to operating? So borrowing money from a bank, would that be financing, investing, or operating? Providing services to customers, issuing common stock to investors, purchasing land, pay rent for the current period, pay dividends to stockholders, or purchasing a building. I'm going to give you a couple minutes and I want you to attempt these. How's everyone doing? Okay, guys, so borrowing money from a bank, it's financing. Providing service to customers would be operating. Issuing common stock to investors would be financing. Purchasing land, investing. Pay rent for the current period is operating. Pay dividends to stockholders is financing, because remember, financing has to do with anything to do with stockholders' equity or a bank, borrowing money from a bank. So when you pay dividends to shareholders, it has to do with the shareholders, because since they're investing in the company, when you pay those dividends, that's a part of the shareholder piece. Purchasing a building is also investing. Does anyone have any questions regarding these before I move on? Is that kind of making sense? Okay. So as I move on, let's do another one of these check your understandings. Transactions related to the primary business activities of a company, such as selling goods and services to customers, are referred to as financing activities, investing activities, or operating activities. What do you guys think? You're going to mark it in the chat. Yay. You guys are rocking it. They are operating activities. Now, transactions of a company that include the purchase and sale of long-term assets are referred to as financing, investing, or operating. Investing. Guys, investing is pretty simple. It's only the purchase and the sale of long-term assets. That's how you can remember that one. Okay. Now we're going to look at how all of this information gets communicated through financial statements. We have 4 primary financial statements that we use to communicate our information. We have the income statement, which you're familiar with now. The income statement is revenues minus expenses equal net profit. We have something called the statement of stockholders' equity we're going to look at. We have something called the balance sheet. And we have the 4th financial statement called the statement of cash flows, or how we actually, how cash flowed in and out of the company, the sources and the uses of cash. So the income statement, which we're familiar with, is going to be the revenues and the expenses over a period of time. So guys, we want revenues to be more than expenses. That is the plan. If revenues are greater than expenses, then we've got net income. If revenues are less than expenses, we've got what's called a net loss. Companies cannot survive on a net loss for a long period of time because, again, the purpose is to provide a profit for the shareholders. The income statement compares the revenues and the expenses for a current period to assess the company's ability to earn a profit from running its operations. So here we've got Eagle Golf Academy. And we see, just for the month of December, we see the revenues and we see the expenses and we see a net profit of $6,000. Okay? That's the income statement. Oh, sorry. That wasn't a net profit. Those were expenses of $6,000, which gave us a net profit or net income of Still a profit. Now let's talk about the statement of stockholders' equity. This summarizes the changes in stockholders' equity over a period of time. So we start with common stock plus retained earnings. Now we know the common stock comes from the shareholders that want to invest in the company. The retained earnings will be derived from the net profits or the net income or minus net losses of a company since its existence. So we start the statement of stockholders' equity by starting with the balance. Now, in this case, this company, the Eagle Golf Academy, is brand new. So its beginning balances were all zero because this was the first month of operations. But then we show the common stock section and the retained earnings section. The common stock section relates to the shareholders. We issued 25,000 shares, $25,000 worth of stock. So we show that in the column for the stockholders or common stock. Retained earnings relates to the internal equity of a company, which came from net income of $1,200. Now we'll learn that the company paid dividends out to the shareholders of $200. So we will subtract any dividends paid to shareholders under the retained earnings section. Why do we do that? Because retained earnings comes from the internal value driven from a company. And the retained earnings is a combination of the net income minus the dividends. We will total those two columns, the common stock and the retained earnings, to come up with our total stockholders' equity. And we see the stockholders' equity related to common stock is 25,000. The equity earnings related to retained earnings is 1,000. It's the 1,200 of net income minus the dividends that were paid out. So we show an ending stockholders' equity of $26,000. The balance sheet is what we presents the financial position of the company on a specific date in time. Now, guys, truly the balance sheet is the accounting equation, the assets, the liabilities, and the stockholders' equity. As you see here, the resources are assets, and then the claims to those resources are liabilities and stockholders' equity of a company. I like to think of a balance sheet as a snapshot. It's a point in time that's usually the last day of the period, the last day of the month, or the last day of the year, or the last day of the quarter. So it will change based on another transaction. And so it is just a snapshot in time of where the company stands at that particular time. So real quick, we're going to go back to this exercise. where we were looking at this Eagle Golf, or Fighting Okra, sorry. And Fighting Okra, we did the income statement. But in addition, it tells us the balance of common stock at the beginning of the year was 200,000. The balance of retained earnings was 32,000. So what we'll want to do here, guys, is in order to create a statement of stockholders' equity, we're going to start by showing the beginning balance of common stock was 200,000. The beginning balance of retained earnings was 32,000. Then it tells us during the year, the company issued additional shares of common stock for 25,000. So that is going to go under the category common stock. Then it tells us it paid dividends of 10,000. Well, we know under the retained earning column, we're going to show our net income. And our net income was here, 22,000. So we're going to show our net income. And we're also going to show a subtraction for the dividends that were paid to the shareholders. This is how we create the statement of stockholders' equity. We start with our beginning balances, and then we add the changes during the period. They let us know that there was additional stock that was issued. And they also told us, we knew what the net income was, and they told us about the dividends paid. Okay. So our ending balances related to Fighting Okra is going to be the common stock, 225,000. It's going to be retained earnings of 44,000. And then the total stockholders' equity, which is just adding both columns, is going to be 269,000. Okay, let me go back to where I was. Okay, so we are going to look at some of these questions on, we've got some various transactions, and we are going to figure out how is each of these classified in the income statement, revenues or expenses, or in the balance sheet as an asset, a liability, or stockholders' equity. And then we're going to ask, what type of activity is this? Is it investing, financing, or operating? So it's telling us here that Falcon purchases common stock of Wildcat. Okay, guys, no, this isn't. This is one company that's purchasing stock in another company. I'm just giving you heads up. It's called an investment, which an investment would be a resource, which means it would be an asset. And basically, when you do a large investment in another company, purchasing an asset, it would be an activity called investing. Okay? So just so you know how that works. The next one, Falcon borrows from Wildcat by signing a note. Now, we know the account is called a notes payable. So what are we going to, I'm going to go into the other room. So what are we going to decide? How are we going to classify this? Is this note payable revenue? Is it an expense? Is it an asset? Is it a liability? Or is it stockholders' equity? What do you guys think? It's a liability. It is money, or we owe claims to those resources. It's a liability where we have a future sacrifice. We owe someone money. And the activity is financing. Remember, financing is borrowing money or issuing stock. Activities related to borrowing money, paying back loans, issuing stock. Wildcat pays dividends to Falcon. Okay, this isn't us paying dividends to shareholders. This is paying dividends to Falcon. And Falcon is showing it as dividend revenue. So dividend revenue will be treated as a revenue account. And we call it operating because obviously for this company, that's how they make money, is by investing in other companies. Falcon provides services to Wildcat. Well, then we're dealing with revenue. And it's also operating because anything related to revenues would be under the activity of operating. Falcon pays interest to Wildcat upon borrowing. That would be an expense. We know anytime you have the word expense after an account, it's an expense and it would be operating. So here we see the balance sheet of Eagle Golf Academy. We show our assets. Our cash is a resource. Accounts receivable, which we'll get into, it's monies due the company from services performed. Supplies are those supplies that are on hand. They're a resource. Once we use up those supplies, they become supplies expense. The equipment is a resource, and other assets. So we see all our assets are totaled at $40,000. Then we have liabilities. We have an accounts payable, a salaries payable, utilities payable, interest payable, notes payable, other liabilities. Do you see something unique with the liabilities? They usually have the word payable. You'll find one in the next chapter where a deferred revenue is also a liability. It's monies that have been paid, but we have not earned them yet. We'll talk about that next week. So we total our liabilities for $14,000. And then we get our information from our stockholders' equity from the stock statement of stockholders' equity. Do you see here that our assets equal 40,000 and our liabilities and stockholders' equity also equal 40,000? This is the accounting equation. Assets equal liabilities plus stockholders' equity. Guys, which of the following accounts would appear in the company's income statement? What is accounts payable? It appears in the balance sheet. It's a liability. What is cash? It's a resource, it's an asset. It appears in the balance sheet. What are dividends? Dividends are a part of stockholders' equity. They appear in the stockholders' equity section of retained earnings. So the answer would be rent expense. It is in the income statement. Revenues minus expenses. Right? Okay. Which relationship is reflected in the balance sheet? Assets equal liabilities plus stockholders' equity. Now we're going to look at the last financial statement called the statement of cash flows. The statement of cash flows measures activities involving cash receipts and cash payments over a period of time. We break them into three activities: the operating activities, investing activities, and financing activities. So all cash transactions involving operating cash flows, we lump there. Transactions involving the purchase or sale of long-term assets, we put there. And financing has to do with lenders and stockholders, we put there. So in this case, we show money that came in from customers under operating, $4,900. And the cash outflows for salaries and rent were at $8,800 for a net minus $3,900 net cash flows from operating activities. Cash flows from investing activities was purchasing the equipment of $24,000. And then cash flows from financing activities is a plus $34,800. The net change in cash is $6,900, which you'll see was part of the balance sheet somewhere here, $6,900. See how the cash, how it links with the statement of cash flows here. Okay, so this exercise wants us to figure out, they have these various transactions. Cash at the beginning of the period is $5,000. What's cash going to be at the end of the period? So if we start with cash at the beginning is 5 and we cash coming in, we add, cash going out, we subtract, we would end up with an ending balance to our cash of $37,000. All we're doing right here is showing money's in and money's out. But then to separate it into a statement of cash flows, we're going to take these transactions and separate them into the various types of activities. So you see cash received from sale of products to customers, that's operating. Cash received from the bank from a long-term loan, that's investing. Excuse me, financing. Cash paid to purchase factory equipment is investing. Cash paid to merchandise suppliers, well, that is operating. Cash received from the sale of an unused warehouse, that's investing. Then cash paid to workers, cash paid for advertising, and cash received for sale of services to customers are all operating. It's why we're in business. Then the cash paid for dividends to stockholders, we know, is financing. So this allows us to put them all into the various categories. Okay. Okay. This, guys, is the statement of cash flows.
Professor, I have a question.
I'm sorry, yes.
Why were they in two different columns?
So this is just a format. This is the totals. So the net cash flows from operating activities, if you add and subtract, this is the net cash flows. This is the 30. This is the net cash flows from investing, the net cash flows from financing. It's just a structure to clean it up.
Oh, okay. Thank you.
You bet. So guys, here is Squirrel Tree Services. It gives us various information as of December 31st. And it wants us to create a balance sheet. And then it wants us to create the statement of cash flows. So you can see here, the balance sheet is a combination of assets and then liabilities and stockholders' equity. We see all of these are assets. So you see they're all showing here and they total 85,000. Then we know our liabilities are, for the most part, going to be anything that has the word payable after them. So we put in our liabilities. We put in our stockholders' equity, which is our common stock and our retained earnings. And we know our assets are going to equal our liabilities plus our stockholders' equity. This exercise is so they can see that you know how to prepare a balance sheet. Then the statement of cash flows is really coming from this information. Customers, borrowing money from a bank, sale of investments. So we know operating activities would involve cash inflows from customers. We know borrowing money from a bank is what? Financing. We know the sale of investments is what, guys? Wouldn't be investing. And then employee salaries and purchasing supplies are operating. Paying out dividends would be financing. And purchasing a building would be investing. So this is the format for a statement of cash flows. We separate the activities by operating, by investing, and by financing. Now, guys, remember this slide, this Zoom class will be recorded and put in the content section for chapter 1. So you can go over this, you can go and go right to the section you want to review. Now, this shows how the financial statements are linked together. So our income statement is added to the statement of stockholders' equity under the retained earnings section right here. See how the 1,200 flows over to the statement of stockholders' equity? Do you see how the statement of stockholders' equity is linked over to the balance sheet? And do you see how the cash, let me move this up here, in the balance sheet will be equal to the cash at the end of the year on the statement of cash flows? Then this really is one of trying to help you understand if you get the various financial statements. If revenues are 27,000 and expenses are 18,000, what does that make our net income, guys? Wouldn't that be the difference? Revenues minus expenses equal net income of 9,000. Whoops. Revenues minus expenses makes our income 9,000. Now, an increase in stockholders' equity is equal to 17,000. They tell us if common stock is 11, which increases stockholders' equity, net income is 12, which increases stockholders' equity, which totals 23,000. What do we need to pay out in dividends to get our increase to only be 17,000, not 23? Wouldn't that be 6,000? You see, if this stockholders' equity is 17 here, and we've got 11,000 in common stock, 12 in net income, we would have to have 6,000 in dividends to end up with an increase in stockholders' equity of 17. If assets equal 24,000, stockholders' equity is at 15, what do our liabilities have to be, guys? Don't they have to be 9? Because we know assets equal liabilities plus stockholders' equity. If the total change in cash is 26,000 and our net operating cash flows are 34, our net investing cash flows are minus 17, what do our net financing cash flows have to be? Don't they have to be 9? All transactions that affect revenues or expenses are reported in the income statement. They ultimately affect the balance sheet through the balance in retained earnings. So this next section just talks about how the role individuals play in the decision-making process. You have options. You have investors or creditors that have only so much money and they have to make a choice. And those choices are made through financial statements. Remember, ultimately, accounting measures business activities, and communicates those activities in the form of financial statements. I'm going to stop here. You guys can continue to read about generally accepted accounting principles, which is kind of what we're governed by in accounting, the guidelines to accounting. And you can look at the global standards versus the United States. I'm going to let you do that on your own because there's not a lot we're going to cover on here, but be aware of the various assumptions here. I think you might have a question or two regarding these underlying assumptions, which means every entity is on its own economic entity. We use the dollar as our unit to value items. And when we create financial statements, we always do it at a period of time. We don't do an income statement since the company began. We do an income statement monthly or quarterly or yearly, annually. And we always assume a company will be continuing on in the future. It will be a going concern, which means it will continue to survive. We assume that when we prepare financial statements. So I want you to look at that. But ultimately, I'm going to now open it up for any questions you have. And then when we're done with any questions, I'm going to stop the recording so we can proceed on to some other things. Are there any questions regarding what we covered today, guys?
Professor, in the balance sheet, are we going to be dividing the assets into short-term and long-term and also
Yes, down the road, we will be doing that. Good question. This chapter is such an overview because we've covered so much today. But down the road, you are correct. We will learn how to separate assets into short-term and long-term assets, those that will get used up within a year and those that will last over a year. And we'll do the same with liabilities, those that will be paid off in a current liability in the current year, and long-term liabilities those liabilities will be here in excess of a year. But for our purposes today, we're just bringing these concepts, the overall concept of assets and liabilities to the forefront.
Okay, thank you.
You bet. Any other questions, guys? So guys, I'm gonna end the recording right now.